Modern markets offer rapid technological scaling and historic economic expansion. Yet, retail investor psychology remains characterized by persistent anxiety. When volatility strikes, the instinctive response is to liquidate. This panic disrupts the specific mechanics required for long-term capital compounding. Financial strategist Tony Robbins and wealth manager Peter Mallouk argue that sustainable independence requires moving past these emotional reactions. They propose replacing human instinct with engineered systems. While retail investors often manage their finances through fragmented, piecemeal advice, the ultra-wealthy utilize a family office model. This hub coordinates investment, tax, and legal experts under a single unified strategy. Within this model, wealth generation is treated as an integrated architecture. Success depends on the interplay between legal protection, tax location, and behavioral conditioning. To evaluate this approach, we will examine historical market timing data, the drivers behind global middle-class expansion, and the specific legal shields used to protect a portfolio. Understanding these systems defines the difference between reacting to a news cycle and capturing the growth inherent in the global economy. The impulse to exit the market during a crisis can be tested against 20 years of historical S&P 500 data provided by J.P. Morgan. This chart shows the baseline performance. From 1999 to 2019, an investor who remained fully committed to the market achieved an 8.2% compounded annual return. For an investor who missed the 10 best trading days in that same 20-year window, returns plummeted to 4.5%. Missing 10 specific days out of over 5,000 cut the final wealth total nearly in half. Missing 20 days dropped returns to 2.1%. Missing 30 days resulted in a total return of 0%. These best days are historically concentrated. 6 of the 10 highest performing days occurred within 2 weeks of the 10 worst days. Avoiding the downturn frequently results in missing the subsequent recovery. A Charles Schwab study provides further context, mapping 4 different timing strategies on a $2,000 annual investment over 20 years. An investor with perfect timing, buying at every market bottom, yielded $87,000. Conversely, an investor with the worst timing, buying at the exact peak before every crash, still ended with $72,000. The real outlier is the investor who remained in cash. That strategy yielded only $51,000, falling $21,000 behind even the unluckiest market participant. Market corrections, or drops of 10% or more, occur roughly once per year, with an average decline of 14%. A full bear market drop of 20% or more happens approximately every 5 years. The historical data indicates that while volatility is frequent, the primary risk to long-term wealth is not a poorly timed entry, but the decision to remain on the sidelines. To maintain discipline through these cycles, investors look to the macroeconomic forces that underpin long-term expansion. Because corporate earnings are tied to the price of goods and services, inflation acts as a structural floor, pushing market valuations higher over extended periods. Growth is further accelerated by the scaling of digital technologies and the demographic shift of 1 billion people entering the global middle class. The scale of this expansion is evident when comparing current standards of living to those of the mid-20th century. Since 1950, average American home sizes have more than doubled, and homeownership has risen from 55% to 80%. When adjusted for inflation, average earnings have quadrupled. This period also saw life expectancy increase by 10 years, while the poverty rate among seniors fell from 50%. He stops entirely after 8 years, having contributed $28,800. By retirement, his portfolio reaches $1.86 million. Bob starts at age 27 and invests $300 a month for 38 years. Despite contributing $140,000, nearly 5 times Joe's principal, he finishes with $1.5 million. Joe's higher final balance, achieved with significantly less capital, demonstrates that time in the market is a more powerful variable than the total volume of contributions. For many, the barrier to starting this process is immediate liquidity. Pre-pandemic data showed that automating these transfers removes the need for recurring decisions, ensuring that the compounding engine remains active regardless of market conditions. Wealth accumulation is only one half of the system. Protecting that capital from taxes, excessive fees, and legal liabilities is equally critical to the final outcome. This matrix differentiates between two strategies. Asset allocation is the spread of investments across different categories. Asset location is the tactical placement of those investments into specific accounts to minimize tax drag. High fees create a similar drag. Over an investing lifetime, a 1% annual management fee can reduce a retirement portfolio's duration by a full decade. Beyond taxes and fees, estate planning acts as a structural defense against unforeseen legal and medical crises. A secure architecture includes 4 primary documents. Without these, the state, rather than the individual, determines the distribution of assets and the execution of medical care. In one instance, a mother was legally prevented from making medical decisions for her injured 19-year-old daughter because the family lacked a healthcare power of attorney. Robust insurance and specific asset protection protocols insulate the core portfolio from these types of administrative failures. Integrating these legal and tax shields ensures that the gains produced by the market are actually retained by the investor. Maintaining these systems requires psychological conditioning. Success in this architecture is weighted 80% toward psychology and 20% toward mechanics. A 6-step framework, ranging from establishing absolute clarity of goals to curating a supportive environment, is used to sustain the discipline required for a multi-decade plan. This discipline can be reinforced through neurobiology. Harvard researchers have measured the physiological effects of power postures on risk-taking and stress. Holding specific postures for 2 minutes has been shown to increase testosterone by 20% and decrease the stress hormone cortisol by 20%, leading to a 33% increase in risk tolerance. These tools support the 90-second rule, an emotional reset protocol designed to stop the neurobiological panic that often leads to portfolio liquidation during a market correction. The complete system integrates historical math, macroeconomic drivers, and structural legal defenses into a single cohesive engine. While much of the literature focuses on U.S.-specific vehicles like 401ks, international investors apply the same core principles by identifying local tax-efficient accounts and low-fee index options. Regardless of the specific jurisdiction, the strategy emphasizes utilizing independent fiduciaries rather than commissioned advisors to protect the integrity of the portfolio. The ultimate metric for this architecture is not raw accumulation, but fulfillment. Without purpose, the mechanical success of the system remains incomplete. A legacy strategy often includes donating cash while living and passing real estate to heirs. This specific sequence utilizes tax rules to maximize the value transferred to both the community and the family. Data indicates that capital allocation toward charitable purposes triggers biological markers of satisfaction that accumulation alone does not produce. This system provides the framework to buy back time. The result is a transition from managing a portfolio to living a purposeful and balanced legacy.